Time for Money Tuesday. You know, maybe you see those ads for online brokerage firms only charging a few bucks to stock trade, and maybe you've been tempted to try it. How hard can it be, right? Well, you can make some costly mistakes, and here to talk more about that is Marshall Clay from the Welch Group. Good to see you this morning.
Hey, good to see you.
There are a lot of mistakes people can make, but you've sort of broken them down into three categories. So let's talk about the first one.
Yeah, and a common theme on our show when I talk with you is controlling the things that you can control. And so these three big mistakes are ones that I see a lot, really from new clients. And so the first one that I think is very common is inappropriate asset allocation. And what we're talking about is that ratio of stock to bond mix, okay? And so I highlight this by saying, look, you know, if you're close to retirement, you're on the verge of retiring within the next 6 months or a year, you probably shouldn't be 100%.
It was just right next.
I mean, that's an extreme example. And so your asset allocation is really just a function of your time horizon, right? Your risk tolerance and your goals. And so it's important to really match those three things up to make sure that you're not overexposing yourself to unnecessary market risk.
This is really important, though, for somebody who does have a 401k and they're trying to think, okay, where should I maybe buy? Because they may have a different, different stocks they can choose from.
Exactly.
So there are certain things you need to kind of look for, right? I mean, I usually look for, you know, obviously over 5-10 years doing very well and not have high expense ratios.
Yeah, exactly. And I think when you're looking at that diversification, I think that's very important too. And I think you bring up a great point that over the last 12 years, what we've seen is a lot of these mutual funds, a lot of these ETFs that are held inside of 401ks, a lot of times they're market cap weighted, particularly if you're linking your investments to an index. So what we've seen is we've seen these large companies like Apple, Microsoft, Google, they're now becoming a larger part of these mutual funds, and they're being held in multiple different mutual funds. So what's even more dangerous than making a conscious decision to lack diversity is when people think they're diversified inside of these ETFs and mutual funds when they're really not. So you may hold Apple, right, in 3 or 4 different mutual funds, and you think, oh, I'm diversified. But if you really take a step back and look inside the weeds, you may actually have a 10-15% position in Apple. Now, don't get me wrong, Apple is a great company, but having a 15% position really in any one company is a little bit.
So really spread it out among the different sectors. All right, the last common mistake you want to talk about.
Yeah, so this is taxes, okay? And so this is a common mistake that I've seen really over the last 12 years. We've had a 12-year bull market, and this really involves taxable accounts, not necessarily those qualified 401ks, Roth IRAs, but we're talking about taxable accounts where people have large positions and they're against taking profits off of those positions because they're just overly tax averse. And look, I don't want anybody to pay more in taxes than they should, but I think it's important for our viewers to get with either a certified financial planner or their tax accountant to really look at the risk reward of continuing to hold these large positions, because if the market turns against you and you have a big concentrated position that you didn't take profits on, it can really hurt your long-term investments.
As we know, things are volatile right now. Marshall Clay with the Welch Group. We do appreciate the insight. Thank you so much.
Appreciate you.
All right, well, a teenager's act of bravery helped save